Welcome to this introduction session. My name is King, the owner and curator of the King Sprint. I am humbled to deliver this course to you. This is going to be the foundation of your financial literacy. For the information that I have shared is my bread and butter, my blood and sweat. I do hope you enjoy it. Welcome to the first episode of this beginner course. By the end of this presentation, you're going to learn what is trading and why should you be a trader. Trading is the buying and selling of currencies, indices, stocks, cryptocurrencies, exchange-traded funds, contracts for difference, and many more at a specific price in time, where if prices appreciates in your favor, it will be added to your initial balance. If prices depreciates against you, it will be subtracted from your balance. Why should you trade the financial markets? Number one, highly liquid. The Forex market is the largest financial market in the world, moving over $7 trillion daily. This means that entries and exits for trades are nearly guaranteed at any point in time. The financial market is open 24 hours a day, 5 days a week, allowing you to trade anytime that suits your schedule. This is especially great for part-time traders or those in different time zones. Leverage opportunities. Brokers often offer high leverage, for example, 1:50 or even 1:500, which means you can control larger positions with smaller capital. You can either profit from rising markets or falling markets. Forex trading involves trading pairs, for example, Euro USD. So you can profit whether a currency is gaining or losing value. Global economic exposure. As a result of Forex trading, it will help you understand macroeconomics, interest rate policies, global politics, etc. This is especially interesting for what school didn't teach you about global finance and economics. Low cost to start. Many brokers will allow you to start with small accounts, even as low as $5. Does this mean you're going to make $1,000,000? Only one way to find out. There is a rich ecosystem of technical and fundamental analysis, automated trading, and strategies. Also mentorship like what you're doing currently at the moment. By the end of this presentation, we are going to learn about some of the Forex participants and their roles in the financial markets. At the top of the pyramid, we do have the central banks and the government. Their main role is setting of monetary policy and interest rates. Sometimes they will do currency intervention when an economy is generally not doing very well. They do hold massive foreign exchange reserves to stabilize the economy. The central bank do offer forward guidance of where the economy is generally headed to through their economic reports that are scheduled by the central banks. Major commercial and investment banks act as major liquidity providers quoting buying and selling prices. They do offer interbank trading, whereby they'll be trading one bank to the next bank, offering their client services in the financial markets. They are the biggest speculators through their risk management and hedging strategies. Hedge funds and proprietary trading firms speculate on currency movements. They usually move large capital and utilize advanced strategies and tools because of their huge risk appetite. Multinational corporations, they do trade in the financial markets for business operations because of hedging currencies against risk as a result of their long-term strategic planning. Let's say, for example, Apple might decide to buy the Chinese yuan in anticipating that the trade wars are going to weaken the dollar. We do have the retail brokers who provide traders with market access. They do offer leverage, they do aggregate liquidity from the top of the food chain, and they do offer tools and technical support to us traders. At the bottom of the pyramid is you and I, but don't worry, we shall climb this pyramid slowly together. This is going to be a walkthrough presentation. By the end of this presentation, you're going to understand Forex market sessions and the economic calendar. There are various websites that you can be using to look at this information. We are going to look at Forex Factory, which is one of the most widely used websites for the economic calendar. If I click on Forex Factory, you are going to see the date on the left hand side, the time, the currency it's going to impact, and the impact of the news release. As you can see, we have various colors or folders. If you have a yellow folder, this means that this news release is going to be low impact expected. If you have an orange folder, it means that this news impact is going to be medium expected. If you have a red folder, this means that this news release is going to be high impact expected. The reason why we look at the economic calendar is to help us plan our trades in the near future, because fundamentals are a vital component in trading the financial markets. Let's take, for example, tomorrow, which is going to be Friday. And an interesting note is that usually on the first Friday of each and every month, we do have an important news release which is called non-farm payroll, whereby it's going to be released at 3:30 p.m. exactly. It's going to affect the United States dollar. As you can see, we have three red folders, which are three high impact expected folders. If I click on the open detail, it's going to tell me this is from the Bureau of Labor Statistics. The measures are this is the change in number of employed people during the previous month, excluding the farming industry. The usual effect is greater than forecast is good for currency. So if the number comes out greater than 133,000, it means that the economy is going to be in a well position. If the number comes out lower than 133,000, it means the economy is not headed in the right direction. It is usually released monthly, usually on the first Friday after the month ends. Why do traders care? Job creation is an important leading indicator of consumer spending, which accounts for a majority of overall economic activity. When this data is going to be released, the markets are going to heavily react to this piece of information. If I click on the history, it's going to bring up the previous NFP numbers. Investors and traders look at these numbers judging on how people are getting employed in a certain economy, in this case, the United States dollar, which is very important for us to look at opportunities in either buying or selling in the financial markets. If I click on the open graph, I can see the numbers over a period of time t. In this particular case, I can look at job numbers ever since January 2021 to May 2025. Moving over to market sessions, if I click on the markets, scroll down, I can come to sessions here, market sessions, whereby currently in Sydney it's 9:14 p.m. which the next session is going to begin in the next 9 hours 45 minutes, which is 12 a.m. my local time. Tokyo session is going to begin in the next 12 hours 45 minutes. Currently, their local time is 8:14 p.m., whereby Tokyo is going to open their doors to trading at exactly 3 a.m. my time. London session is currently open, which is going to end in the next 4 hours 44 minutes, which is going to be 7 p.m. my local time. And New York session is about to begin in the next 44 minutes, which is 3 p.m. my local time. There are other various websites that you can look at to see Forex market hours in a much more clearer depth. You just have to type in Forex market hours. We do have babypips.com, whereby it's going to show you the sessions that are currently open and closed. As you can see, we do have trading volume, which usually peaks in between the overlap session, which is when London is about to close their markets and New York has just opened. This is whereby we do see most of the volume being traded in the financial markets. Another website that you can look into is Forex Market Hours or the Forex Market Time Zone Converter. An important thing to note is that always ensure that it corresponds to your local time over here. Now, the good thing about this website is going to include the DST, the Daylight Savings Time, whereby if you look at this table over here, it's going to show us Frankfurt, Germany currently is open, whereby it did open at 9 a.m. It's going to close at 5 p.m. London session did open at 10 a.m. It's going to close at 6 p.m. The next session is due to begin for New York, whereby it will open at 3 p.m. and close at 11 p.m. local time. Australia, which is Asian session, it's going to open at 1 a.m., close at 9 a.m. Then we do have Tokyo session, which is due to begin at 2 a.m. and then close at 10 a.m. Once again, the good thing about this website that I'm showing you, it's going to include the daylight savings time, which some of the other websites do not include. If you look at Tokyo, Japan, for example, their closing time is going to differ with the other websites. By the end of this presentation, we are going to understand what can you trade in Forex. Basically, anything that can be bought or sold in the financial markets usually can be traded. What are some of the assets? First, we have currencies, also known as fiat paper. There are three types of currencies, namely major currencies. These are developed and widely traded currencies in the world. The first one, the United States dollar, the euro, the Japanese yen, the Great British pound, the Swiss franc, the Canadian dollar, Australian dollar, and the New Zealand dollar. The next type of currencies we do have is the minor. These are not highly liquid currencies compared to the majors, but are still widely traded. For example, the Swedish krona, the Norwegian krone, the Danish krone, the Singapore dollar, Hong Kong dollar, South African rand, Turkish lira, and the Mexican peso. The final type of currencies is what you call exotics. Now, these are developing or emerging currencies. For example, the Kenyan shilling. Why should we trade major currency pairs in the financial markets? Number one, major pairs have the highest trading volume in the world. This means you're going to have fast execution in your trades, and as a result of the tight spreads and high competition among brokers, trading major pairs is cheaper for us as traders. Major pairs tend to move in predictable patterns compared to exotics. This is great for learning price action, chart patterns, and using indicators. Central banks like the Federal Reserve, the European Central Bank, Bank of England, and Bank of Japan are transparent and their policy decisions are widely reported. This makes it easier for us traders to anticipate fundamental shifts in the financial markets. There is plenty of market research, news, and forecasts which are available for major currencies. Also, this makes it easier for us traders to analyze and make decisions in the forex market. The other type of assets in the forex market is what we call commodities. Under commodities, we do have the hard commodities, which is natural resources. For example, oil, which affects currencies like the Canadian dollar and the Russian ruble. We do have gold, termed as XAU in the financial markets, which is often a safe haven asset and is considered an anti-dollar. We do have silver, platinum, and copper, which is majorly for industrial and investment purposes. We do have soft commodities, which are majorly agricultural products. For example, coffee, cocoa, sugar, cotton, wheat, corn, or soybeans. Why should you look at commodities? Because of the currency correlation. Canada is heavily reliant on energy and is tied to oil. The Australian dollar is linked to metals such as gold and iron ore because of the major reserves they have within their country. The New Zealand dollar correlates with dairy and agriculture because of their vast knowledge in the agricultural sector. It has an impact on inflation because rising commodity prices often push inflation higher, influencing central bank policy and thus currency strength. Commodities are considered safe havens in risk on or risk off sentiments. In times of crisis, investors usually flee to gold. In risk on environments, they may buy emerging market currencies and industrial commodities. The other type of asset in the financial market is what we call indices. This is also known as stock market indices, which is a way to track the performance of a group of stocks that represent a particular sector, region, or market. Some of the indices include the S&P 500, which tracks the performance of the 500 publicly traded companies in the United States, and is often used as a benchmark for the overall performance of the US stock market. We do have the Nasdaq, which includes over 3,000 stocks listed on the Nasdaq Stock Exchange. It's heavily weighted towards technology companies, including major ones like Apple, Microsoft, and Amazon. We do have the Dow Jones Industrial Average, which is composed of 30 largely publicly traded companies in the United States, such as Coca-Cola, McDonald's, and IBM. This is one of the oldest and most widely followed stock indices. We do have the FTSE 100, which represents the 100 largest companies listed on the London Stock Exchange, which is a key indicator of the UK stock market's health. The DAX tracks the 30 largest and most liquid companies in Germany, which is a major benchmark for the German stock market. The Nikkei 225 tracks the largest companies on the Tokyo Stock Exchange and is a primary gauge for the Japanese stock market. The Hang Seng Index measures the performance of the largest companies in Hong Kong, which is widely regarded as a key indicator of the Hong Kong stock market. The CAC 40 is a benchmark index for the French stock market consisting of 40 of the largest listed companies trading in the financial markets of France. The ASX 200 tracks the largest stocks on the Australian Stock Exchange, which is a key indicator of the Australian stock market's performance. We also do have the Russell 2000, which measures the performance of 2,000 small cap stocks in the United States, which provides traders with insights into the performance of smaller companies compared to large cap stocks, and many more others. In front of you is a price chart. Technically, it's a graphical representation of price against time. Specifically, this is a candlestick chart pattern. Candlesticks were developed by rice traders in the 18th century, whereby traders noted the prices of rice at the start of the season, how the season progressed, and how the season closed. So they had 4 price points. If prices did open, formed a low, then a high, and finally closed, they would consider this a bullish candlestick. This is what we consider the opening price. This is the low of the candlestick that's formed, the high of the candlestick, and finally the closing price. This is what we call the wick. A wick is essentially prices retracing to where it originally did start from. If prices began here, went to the downside and then retraced, this is what we call a wick. This is the body of the candlestick, and this is where prices did rally to in a specific point in time. On the other hand, we do have what we call a bearish candlestick, whereby if prices opens, rallies to the upper side, moves to the lower side, and then finally closes within a period of time t. Let's say, for example, the 1 hour time frame, what you're looking at in front of us today. This is what we consider a bearish candlestick. Once again, this is going to be considered the wick of the candlestick to the upper side and to the lower side. The reason why we call this a bullish candlestick is because whenever bulls are fighting, it usually draws their horns towards the upper side. We call this a bearish candlestick because whenever bears are fighting, it usually draws their claws from a higher side to a lower side. If you look at this price action, from this low to this high, we can say this is a bullish move whereby prices was running to the upper side. It's a bull market. Bulls are in control. Buyers are in control. If you look at this market from this leg over here to the downside, we can say that sellers are in control or the market is bearish. Yes, there are other types of charts that you can be looking at. For example, we do have a line chart, which essentially is a line. We do have bar charts, which is almost similar to a candlestick, whereby it's going to show the opening price, the low of the candlestick, the high formed, and finally the closing price. We do have so many types of charts to be looking at, but we usually like looking at candlestick chart pattern because they are visually attractive. They present information in a clear manner. How do you look at these charts? There is what we call time frames, whereby a 1 hour candlestick is made up of smaller time frames. A daily candle is also made up of smaller time frames. When you're looking at the charts, it's advised you start from a higher time frame moving to a lower time frame to get the overall direction of the markets. You can start from the weekly time frame, moving down within the time zones. As you can see with this weekly time frame, I do have 15 hours 36 minutes to go for this candlestick to close, then the next one opens. Today is Friday, so the weekly candlestick is going to end in the next 15 hours, and then we go to a weekend, then the next weekly candlestick is going to begin next Monday. Remember, the higher time frames is composed of smaller time frames. You look at the higher time frame to get the overall perspective of where prices are headed to. If I look at it on the daily time frame, I can see that prices are generally trending to the upper side. But if I go down in the lower time frames, I get a different perspective of what the markets are telling me. If I look at it on the 1 hour time frame, I can tell that the markets are generally bearish. The higher the time frame, the clearer the direction. But an important thing to note is higher time frames are usually composed of smaller time frames. The smallest time frame you can go to on this chart is the 1 minute time frame, whereby each of these candlestick is going to take, you can reset the chart. This is what you call trading view. Each of these candlestick is going to take exactly 60 seconds. When the time limit elapses, the next candlestick is going to begin. For purposes of education, it's advised for you to look at a candlestick that is going to be beneficial to you, specifically the type of trader that you're going to be. If you want to be a scalper is a trader who takes a lot of positions on the smaller time frames, whereby you can buy here, sell here. This is almost, if you take a ruler, we can speculate how many minutes this was. So this was 138 bars, which is equivalent to 138 minutes, more or less 2 hours ever since 4 to nearly 6 a.m. currently. A scalper will look at the 1 minute, the 2 minute, the 3 minute, the 5 minute. An intraday trader will be looking at the 5 minute, the 15 minute, the 30 minute, and the 1 hour. A day trader will be looking at the 1 hour and the 4 hour. The highest time frame they'll be going to is the daily time frame. A swing trader will be looking at the daily candlestick, the weekly candlestick, and the monthly candlestick. We do have another type of trader who are called position traders, whereby they'll be holding their positions for more than 6 months. This is very crucial for you to understand because it's going to depict what type of a trader you're going to be in the financial markets. If you are going to be looking at the charts for less than an hour a day, it's advisable you become a scalper. Look for a strategy that is going to enable you to find opportunities within an hour's time frame. Meaning you'll be focusing more on the 1 minute, the 2 minute, the 3 minute, the 5 minute, the 10 minutes, the 15 minutes maximum, whereby you'll be entering and executing positions several times a day. If you want to be an intraday trader, whereby you'll be looking at several positions within a day, let's say for example, if I was to have sessions, click on indicators and you just input session breaks. There are so many that you can be looking at. Let's pick Lux Algo. The moment I click that, it's going to pop up on my chart. Let's look at a clearer chart. Let's say for example this one. It's still a chart of XAUUSD, meaning this is gold against the United States dollar on the 1 hour time frame. Let's have Sydney session a brighter color. Let's say for example green. And then okay. So I can see currently at the moment we are in Asian session still. London is about to open, and as you can see, this indicator is going to break down the sessions for you, whereby you can tell that this is Sydney session, Tokyo session, London session. Remember the overlap. The overlap is when London session is about to close and the New York session has just begun. And this is very crucial for us traders once again because it enables us understand sessions better. If you look at the overlap between London session and New York, we do have very healthy amount of candles. By healthy candles, I mean we do have a lot of volatility whereby prices are very aggressive. If you look at this particular day, we did have this massive candlestick. On the previous day, we did have this massive candlestick, and so on and so forth. This is going to be a walkthrough of MetaTrader 5, and we are going to start by top left, whereby if you click on File, click on Login to Trade Account. When you open an account with a broker, they are going to send your login details to your email, whereby they're going to send your login number. Your password is the one that you use to create the account, and the server always ensure that you have three details correctly. If I click on View, these are the shortcuts to the Market Watch, Data Window, Navigator, Terminal, Strategy Tester, and the charts. Remember, for a transaction to be completed, there need to be two parties. In Forex, we call these pairs, whereby if you're looking at a Forex pair, let's say for example, USD, Canadian dollar, if I left click on it and I drag it to my screen, it's going to pop up a chart of USD Canadian dollar. This is the 15-minute time frame. The lowest time frame I can go to is the 1 minute time frame. The highest time frame I can go to is the monthly time frame on MetaTrader. For purposes of education, we are going to be sticking to the 1 hour time frame. I do have these lines on my chart indicating session breaks, meaning if I do have it on the 1 hour time frame, from this line to this line is going to signify one trading day. If I do decide to pull up another chart, but I can't see it on my market watch, I hit the shortcut Control U. And then this is going to pop up the symbols tab, whereby I'll find all the symbols that I want to look at. Let's say, for example, I want to add GBP, JPY. I just click on show, and then GBP, JPY is going to pop up on my chart. This is going to be the bidding price, whereby this is the price the broker is going to offer for you to sell GBP JPY, and this is the price the broker is going to offer for the buying price. The difference between the two is what we call the spread, which you can see here. This is the same as 15 points or equivalent to 1.5 pips. If I go to Insert, Indicators, scroll down, I can look at various indicators that I can add to my chart to help me in my analysis session. Let's say, for example, I do click on trend. I do have a moving average already, the red line that you see on the chart. This is a 14 moving average, and if I click on properties, it's a simple moving average applying to the closing price of candlesticks. Basically, what I'm instructing MetaTrader to do is look at an average of 14 candlesticks and apply a mathematical formula for it to come up with this line over here. This is whereby you enter your lot size, whereby the lowest lot size you can do execute on the financial markets is a 0.01. The higher you go, the higher the lot size that you can physically go to. I want to talk about market orders and stop orders. If I do decide to sell this market, the broker is going to fill me in at this price. If I do decide to buy, it's going to fill me in at this price. This is what you call market execution, whereby you are going to be filled in at the price that you're seeing currently on the screen. If I right click on the chart anywhere and I click to trading, you can see we have a buy limit and a sell stop. If I do click on a buy limit, this is essentially instructing the broker, if prices do reach this region here, fill me in for a buy. I can drag the sell limit to whichever point that I would want for it to go to. If I right click on it and then delete, the order is going to be deleted. If I right click on my mouse, go to trading once again, but instead have a sell stop, basically I'm instructing the broker, if prices reaches this particular point, fill me in for a sell position on GBP JPY. Once again, if I right click on it and then modify, this is whereby I can input my stop loss and my take profit. Let's say I have my stop loss at 192.4 and then I have my take profit at 191. If I click modify, the position is going to be modified, whereby you can see this is going to be my stop loss. I can also drag the stop loss to whichever point I want. If you look to the left hand side, the higher the stop loss, the more the money you're risking. For example, if prices do fill me in at that point that I've set myself stop at, to my stop loss, it's going to be $65 loss. If I do drag it to the upper side, the more money I'm standing to risk on this particular trade. The same can be said if you do drag your take profit further to the downside. As you can see, the amount of money that moves on the left side of the chart currently at $123. If I do drag the take profit further to the downside, the more money I potentially will make on this particular execution. If I click on the upper side of the chart, anywhere on the upper side above price, above where price is, if I right click on it, then I go to trading. If I do click a sell limit, I'm basically instructing the broker, if prices reaches this particular point, fill me in for a sell position. So currently it's a sell limit, but if prices do happen to retrace to this region, it's going to fill me in for a sell position. If I right click on that order and then modify it, it's going to bring up this pop-up whereby I do have the opportunity to fill in a stop loss and a take profit. Let's say, for example, I have my stop loss and I have my take profit further down. Remember, when you're selling, you're anticipating prices to go to the downside, meaning your stop loss needs to be above price, your take profit needs to be below price when you're selling, and then you have to confirm by pressing modify. An important thing to note is that if you don't have the right values, it's not going to allow you to modify your position. Let's say, for example, if I do drag this take profit to the upper side, you can hear that sound. It's not going to allow me to modify my position. Always ensure that you have the right parameters on your trading. If you want to delete this position, just click on delete. If I do right click on the chart once more and then I click on trading, if I do click on buy stop, basically I'm instructing the broker, if prices happens to reach, let's say for example, I have my buy stop around that region. I'm instructing the broker, if prices reaches this point, fill me in for a buy order. Remember, when you're buying, your stop loss needs to be below price, your take profit needs to be above price. I can modify these. Let's say, for example, I have a stop loss at around this region. Notice if I have an invalid stop loss, it's not going to enable me to modify the position because the stop loss is invalid, but I need to have it just below price and my take profit needs to be above price. And then click on modify position. When you're executing in the marketplace, it's advised that you have at least a 1-to-1 risk to reward ratio, whereby if I'm risking $1, I'm targeting at least $1 in return. It doesn't make sense for me to risk, let's say for example, $300, $342 to target $99, for example. For some people, yes, it does work, but as a beginner trader, you will want at least a 1-to-1 risk to reward ratio to enable you find your routes in the financial markets. Once again, if I do right click on it and then delete the position is going to disappear. If I click on Control T, the tab is going to pop up, whereby if I do have any positions currently at the moment, it's going to show up on this region here, whereby I'll have the opportunity to close my position. On this tab over here, this is your cursor, whereby you will be able to peruse through the assets that you're looking at. Remember, this is your market watch. These are the currencies or the assets that you're going to be trading, the bid price, the asking price. This is the current time for the broker. Sometimes it will vary depending on where the broker has situated their servers. On the right hand side, we do have the crosshair, whereby it's going to pop up a crosshair. Let's say, for example, I want to measure how many pips did price move yesterday from this low to this high. What I do is I take my crosshair to the low, left click it, and then drag it to the upper side. I can see that this one is 15 candlesticks. If I'm looking at the 1 hour time frame, this means that this is equivalent to 15 hours of trading, and prices did move 3,113 points, which is equivalent to 311 pips. Remember, 10 points is equals to 1 pip, up to 193.50, where is the current price. Let's look at another asset, for example, gold. If I want to measure the movement of pips from this region to this region, I click on my crosshair from whichever place I want to measure the movement. Let's say, for example, from this high to this low. As I can see, this one is equivalent to 61 candlesticks, 61, 62 candlesticks, which is equivalent to 62 hours if I'm looking at the 1 hour time frame, and is equivalent to 14,996 points. Let me have it at 15,000, and this is equivalent to like 15,000 points, which is equivalent to 1,500 pips, from $3,353 an ounce to where prices to where the lows were at 3,202 is equivalent to 1,500 pips. If I click on insert, once again, it's going to show me the indicators. I do have lines. Let's say, for example, I want to draw a trend line. I can have it as such. If I do want to click on a Fibonacci retracement, this is a very good tool to be using, whereby it's going to show you potential price reversals in price. Let's say, for example, if I'm looking at XAUSD, price is in the golden retracement region, and this could signify a potential reversal back to these lows. If you right click on your chart, go to properties, this is what you can have. You can customize this to show whatever you want. Let's say, for example, a bar chart. If I click on OK, a bar chart is going to pop up. There is a shortcut up here, whereby if you click on charts, you can go to either a bar chart, a candlestick chart, or a line chart. But for purposes of education, we are going to be focusing on a candlestick chart. Once again, if I right click it, go to properties, these are the colors that I use. You can pause the video and look at how I have set my current chart to be. If I want to execute a position and I want to be nitty-gritty before I place an order, you click on new order, and then this is going to pop up. So you're going to have the liberty to choose between market execution. Remember, market execution, it's going to fill you in at the prices that you see on the charts. Click on this arrow down. I'm going to have an opportunity to set a pending order. If I click a pending order, I have the opportunity of setting either a buy limit, a sell limit, a buy stop, or a sell stop. Once again, if you do set a buy limit, always ensure that you have the correct parameters in place. Always ensure that, let's say, for example, you're anticipating prices to come back down for it to move to the upper side. What I can do is highlight a region. Let's say, for example, so I can have it here as 32.47. I need to have a stop loss. I look at how much I'm willing to lose. Let's say if I have a stop loss at these lows, this is almost 500 pips if I can approximate it. 500 pips at exactly 31.98. So my stop loss is going to be at 31.98, which is equivalent to 500 pips. I ask myself, okay, if 0.01 is equivalent to $50, meaning if I do have a 0.02, I'm going to risk $100. If I do have a 0.1, it means I'm going to be risking $500. If I do have a 1.0, it means I'm going to be risking 1000. So look at your account size, ask yourself, how much am I willing to lose? Let's say, for example, in this case, I go with the lowest lot size possible, a 0.01, a stop loss around that region. Remember, I also need to have a take profit. So a take profit, if I could look at this chart, ideally my target needs to be around 33.20. So I do input 33.20 on this region, and then I place the buy limits need to be at 32.47, and then I place the order. TradingView is really good because it's a good analysis tool, whereby if I want to speculate this market is going to buy, I can project prices. Let's say, for example, I come to these forecasting and measuring tools. There is a long position and a short position. If I anticipate the market is going to buy, I do pick the long position, and then I come to my chart. Let's say this is going to be my entry. My stop loss needs to be below structure. So a stop loss is whereby you instruct the broker, if the trade goes against me, because trading is all about probabilities, 50% of the time when you buy, it will go in your favor. But there's also a probability that when you buy, it might sell. You need to calculate risk management. You need to make yourself aware of worst case scenario, whereby if this market does happen to go back down even further and I have executed a buying position, I need to have insurance policy so that I don't lose my entire trading capital. This is going to be very crucial because it will enable you stay in the game for longer. If I do take this price projection, I can anticipate that if I do buy here, my stop loss needs to be below this region, because if prices do happen to continue moving to the downside, if prices do break this region, there's a high probability it will continue moving further to the downside. But on the other hand, I'm anticipating that these prices will move to the upper side. So I need to ask myself, where would I want to get out from if this trade does happen to go in my favor? And the most realistic target will be this high. This is going to give me a stop loss of 5,657. This is points. But remember, 10 points is equivalent to 1 pip. Never forget that. 10 points is equivalent to 1 pip. So when I have 5,657 points, it means this is equivalent to 565 pips for my stop loss, and almost 24,177 points, which is equivalent to 2,400 pips. I'm going to have a risk to reward ratio of 1:4.27, whereby if I'm risking 1 point, I'm targeting 4.27 in return. If I'm risking $1, I'm targeting $4.27 in return. This is going to be crucial because if you go to your execution, whereby if you do go to your MetaTrader and execute a position, you can anticipate how much you're going to lose. If I do have a position of, let me have this one here, one lot is equivalent to 100,000 units. Is equivalent to 100,000 units of price. What this means is that if I do execute a one lot size on my MetaTrader, this is equivalent to $10 a pip. If I do execute a 0.1 lot size on my MetaTrader, this is equivalent to $1 per pip. If I do execute a micro lot, 0.01 lot size, which is the smallest lot size you can use in the financial markets, this is equivalent to 10 cents 10 United States cents per pip. This is constant, it never changes whichever the market you're looking at. If I look at this probability here, let's look at a trade that I'm currently in. So this is a trade whereby I was risking 660 pips to target 1144 pips. If I did execute a 0.01, this means I'm targeting almost $66 in terms of loss if it goes against me, but at the same time my target is going to be around $114 if it goes in my favor. If I do execute a 0.1, it does mean that this is going to be $1 per pip. Let's look at this example whereby if I do execute a 0.1 for 565 pips is going to be equivalent to $560, looking at from my entry price to my stop loss, and I'll be targeting almost $2,400 if it does go in my favor. On the other hand, if I execute a one lot size, which is a one standard lot, this means I'm going to be risking almost $5,600, but I'll be targeting $24,000 if the trade does happen to go in my favor. It's always advised to be looking at risk management in terms of percentages so that the probabilities will play out in your favor over the long run. If I do risk 1%, I'm targeting 4% in return. Ask yourself, if I do have an account of X amount of money, how much am I going to risk on this particular execution so that if it does go in my favor, I will make 4.27, but if it doesn't go in my favor, I'm only going to lose 1.74% of the total value of this index. From the entry price to the stop loss is equivalent to 1.74% of the value of gold currently at the moment. So ask yourself, I have an account of $1,000. How much would I want to risk on this particular execution? If I use a 0.01, then this means I'm going to be risking almost $56. If I use a 0.1, $560. If I risk a 1.0, then this is going to be almost $5,000. So I cannot execute a one lot size because already my account does not have sufficient margin for me to open this position. A question still begs, what if I'm still having trouble calculating lot size? Don't worry, I'm here to support you. Supposedly, I've done my analysis on Euro USD, pull up a Fibonacci from this low to this high, and I'm asking myself, okay, there's a possibility that prices will continue buying further to the upper side. What I'm going to do is pick up a forecasting tool, a long position. I would want to enter euro dollar around 1.13085. My stop loss just below this low. My take profit is going to be among these highs for a risk to reward ratio of 1:5.6. But I don't know how many lot size I'm going to execute on my MetaTrader. Don't worry, there are so many websites that you can be looking at. You just have to type out position size calculator. Several are going to pop up. Let's pick the first one. I'm going to look at Euro USD. The account currency is going to be in terms of dollars. Let's say I have $1,000 and I want to risk 5% of my account on this position. It's going to tell me to specify my stop loss. I'll go back to my trading view. My stop loss is going to be 46 pips. When you're looking at currencies, it's not going to measure in terms of points in trading view, it's going to measure it in terms of pips. This is around 46 pips. I can have it at 50 to give my stop loss some breathing room. I'm going to specify 50 pips. I'm going to leave the trade size lots at 1 and then I'm going to hit calculate. And I need to push at least 10,000 units of currency on my MetaTrader. This brings me to 0.1 lot size on my MetaTrader. I will pull up my MetaTrader, click on new order, input a 0.1 lot size. I will ensure that the volume is 0.1 lot size. Remember, it's a buy limit that I'm looking at, so I'll click on pending order, buy limit at 1.13085. My stop loss is going to be at 1.12582. My take profit is going to be 1.1571. I'll double check everything once more. Lot size, stop loss, take profit, my entry price, and then I'm going to hit place. As you can see, the order has come to my screen. If I bring the cursor to where my stop loss is, as you can see, I am risking $50 on this particular execution. If I look at my take profit, which should be somewhere around, I zoom out. Here is my take profit. I am targeting $261 in return. If you have reached this part of the presentation, I want to congratulate you. You have just tackled the hardest part of trading, which is getting started. This is just the tip of the iceberg. Welcome.